What is breadth of market theory? The breadth of market theory is a technical analysis methodology that measures the strength of the market according to the number of stocks that advance or decline in a particular trading day, or how much upside volume there is relative to downside volume. The breadth of the market theories is the basis for the breadth of the market indicator. Key takeaways. The breadth of market theory uses breadth indicators to help assess whether the major stock indices are likely to rise or fall. Breadth indicators look at the number of advancing stocks versus declining stocks, or advancing volume versus declining volume. A rising breadth indicator where advancing stocks and advancing volume is outpacing declining stocks and declining volume is generally considered positive for a price advance in the stock indexes. When breadth indicator diverges with a stock index, it may warn of a potential change in the direction of the index. Understanding breadth of market theory. There are multiple ways to analyze market breadth, which is a measure of robustness of the stock market as a whole. The overall robustness of the stock market may not be evident by only looking at major market indexes such as S&P 500, Nasdaq 100, or Dow Jones Industrial, since these indexes only hold a select group of stocks. Breadth is typically a measure of how many stocks are advancing relative to the number of declining. Alternative, it may also include volume studies such as volume in rising stocks versus volume in falling stocks. Advanced decline indicators measure the number of stocks advancing and declining for the day. If the breadth indicator is rising over time, this indicates the market is strong and the rise in the index is sustainable. For example, if a market is comprised of 150 stocks and 95 stocks experience price gains while 55 stocks either experience no change or decline in price, according to the breadth of the market theory, the market is considered strong or rising. If the advanced decline line falls while the major stock indexes rise, this indicates that fewer stocks are participating in the rally and could forewarn of a fall in the index. As fewer and fewer stocks rise, the index performance will eventually begin to suffer as well. Breadth indicators are not accurate timing signals. While they may warn of a decline, they don't indicate when it will happen. Similarly, a rise in breadth indicators while the major indexes are declining warns that buying pressure is building and indexes may start to rise soon, but it does not tell us when. Special considerations. Breadth indicators often act in tandem with prices moves in indexes. For example, a rise in the index sees a rise in the breadth indicator. This is called confirmation. When the breadth indicator diverges, it warns of potential change in the index direction. Changes in index direction are not always forewarned by breadth indicators. Market indicators look at how many stocks are advancing and declining, and volume to determine how strong the stock market is. Dow theory also looks at the robustness of the market but uses different tools. One of the tenets of the Dow theory, and there are several, is the industrial and transportation indexes should confirm each other. When the two are moving in different directions, it could signal trouble. Popular breadth of market indicators. Two popular market breadth methods include the advanced decline ratio ADR and the advanced decline line AD line. The ADR compares the number of stocks that close higher against the number of stocks that close lower than the previous day's closing price. To calculate the advanced decline ratio, the number of advancing stocks is divided by the number of declining stocks. The advanced decline ratio is typically calculated daily. The AD line plots changes in advances and declines on a daily basis, and the result is cumulative. Each data point is calculated by taking the difference between the number of advances and declining issues and adding the results to the previous period's value, as shown by following formula. AD line equal number of advancing stocks minus number of declining stocks plus previous period's AD line value. Shorter term breadth indicators include the tick index and the arms index trend. The tick index compares the number of stocks advancing on an uptick versus a down tick. This is an intraday indicator. The arms index compares the advanced decline ratio to advancing divided by declining volume. Other breadth indicators include on balance volume, OBV, up and down volume ratio, and the McLean summation index. breadth of market theory example. The S&P 500 could be compared with the New York Stock Exchange AD line to monitor underlying strength or weakness. The New York Stock Exchange AD line is looking at all stocks listed on the New York Stock Exchange, while the S&P 500 is only tracking a select group of 500 stocks. The New York Stock Exchange AD line provides a broader measure of how stocks are doing. This chart below shows the SDR SP 500 ETF spiders along with the New York Stock Exchange AD line. In the early 2018, the SP 500 was moving lower, but in April, the New York Stock Exchange AD line was making new highs. The S&P 500 was nowhere near its highs, yet ultimately the index followed suit and made new high likes the AD line. Once again, in early and mid 2019, the New York Stock Exchange AD line moved above prior highs in advancing of spider moving above corresponding highs. The S&P 500 followed suit and eclipsed the prior highs. Breadth of market theory limitations. Breadth of market theory is looking at historical data. Like any data, new data could come in to invalidate the old. For instance, a trader may exist long positioned as the index goes up, but breadth indicators decline. The index may keep going and the breadth indicators may start going up as well to confirm. Breadth indicators are not timing signals. While they provide beneficial information about the state of the market, they don't signal when it will decline. For that, traders need to watch price action. Breadth indicators can provide forewarning, but price action will provide the actual trade signals. Breadth indicators are best used in conjunction with price action and other forms of analysis to determine buy and sell signals. Breadth of market theory is an effective indicator to use in your trading system. It can not only be the one indicator you can use, but a weight of evidence. I encourage you for the breadth of market theory to study it, analyze it, and adapt it. Peace.